We can't overdose on Ben Graham. And in fact, one of the big problems I had in life was there was too much Ben Graham and too little Charlie Munger. Ben Graham talks about a lot of other things. My suggestion is to not focus on the rest of it because it might hurt you more than it helps you. We don't need to know everything about everything. If we know a little bit, we can do a lot. John Templeton used to say that the best analyst is going to be wrong 1/3 of the time. I think 1/3 is very low. We're going to be wrong more than half the time. Over the last 60 years, Warren has made 300 or 400 different investments and key hires. Out of those 300 or 400, it has been 12, according to him, that has led to the creation of Berkshire Hathaway. So even for someone like Warren Buffett, it has been a very low hit rate. It's been a 4% approximate hit rate, maybe a 3% hit rate. Obviously, with capital allocation, we start with Ben Graham, but one needs to calibrate. So we can't overdose on Ben Graham. And in fact, one of the big problems I had in life was there was too much Ben Graham and too little Charlie Munger. So Ben Graham, the three important tenets that he came up with, the three very important models, which are very important, which is you're not buying a stock, you're buying a piece of a business. Mr. Market is there to serve you, not to advise you. So we're not trying to learn something about a company with the stock price. And the third is the margin of safety. We always want to be buying things well below what the underlying value is. And again, the thing is that Ben Graham talks about a lot of other things. And I think my suggestion is to not focus on the rest of it because it might hurt you more than it helps you. One of the things to remember about Ben Graham is he was very smart, but his entire security analysis came from the experience of the 1930s. And the 1930s were a very extreme time in US market history where we had severe dislocations, right? With 25% unemployment and so on. We did not see that level of unemployment in the financial crisis or during the pandemic or anything else that's happened since then. So it's possible it may happen in the future, but we really should not be investing with the framework of assuming it's happening next week. Buffett talks about the 20 punch card. He says that if you think about that in an investing lifetime, you only get to invest in 20 stocks. And each time you invest in a stock, you punch the card once, kind of like at Subway or something. And when you're done with 20, that's it. If that were the rule that you had to apply, then all of us would be very careful about what we invest in. Because basically in an investing lifetime of maybe 70 or 80 years of investing, on average you'd be making one bet every 3 to 5 years. And so fast is slow. And so you're better off slowing things down, and you're better off looking at things from a perspective where we want to make very few bets and we want to be very thoughtful about how we make those bets. Then we get to the circle of competence, and the importance of circle of competence is what Warren says, which is the size of the circle is not very relevant, but staying in its epicenter is very relevant. That picture you see has two gentlemen and a lady. The guy on the left is Mark Andreessen. The lady in the center is his wife. And the guy on the right is her father, John Arriaga. So John Arriaga he passed away, I think, 2 or 3 years back, and he was a billionaire. So his daughter is a billionaire to the power of billionaire. So, she starts with $1 billion and then she marries a billionaire. Anyway, the thing is, John Arriaga was a friend of Charlie Munger's, and his circle of competence was extremely tiny. He only invested in real estate within a mile of the Stanford campus. And his whole life, that's all he did. He never ventured beyond that. And starting with nothing, he became a billionaire. And if you walked with John Arriaga around the Stanford campus, every single building, he could give you the history of when it was built, who owned it, what the rents were, what were the different transactions, when it was bought and sold. He knew everything about every piece of real estate around. And basically, he acted on these properties when there was distress. So usually whenever there were downturns and people were distressed and these properties came up, he knew which were the ones he wanted and was always under-levered, loaded up when everyone else was feeling pain, and then just kept these properties forever and did extremely well. We should always remember that we don't need to know everything about everything. If we know a little bit, we can do a lot. It's guaranteed that we're going to have a very high error rate in this business. And John Templeton used to say that the best analyst is going to be wrong 1/3 of the time. I think 1/3 is very low. We're going to be wrong more than half the time. And when you look at this, 30% or 50% error rate, in reality, if we look at US equity markets over the last 90 years, that basically about 4% of companies have delivered all the market returns. So it was very important to be invested in those 4% companies. And if you miss those, then things wouldn't work out, and which is why the index does so well, because the index owns the whole thing, and so it gets the benefit of that. So most equities that are publicly traded are not good investments. The overwhelming majority of them are not good investments, which again goes back to the 20 punch card. The 4% is actually very similar to what Warren pointed out a few years ago, where he said that 12 ideas that he had over time had led to the creation of Berkshire Hathaway. And I took a stab at what I think those 12 ideas are, with probably Ajit being number one and so on. But basically, if you think about Berkshire Hathaway over the last 60 years, Warren has made, I would guess, at least 300 or 400 different investments and key hires. And out of those 300 or 400, it has been 12, according to him, that has led to the creation of Berkshire Hathaway. So even for someone like Warren Buffett, it has been a very low hit rate. It's been a 4% approximate hit rate, maybe a 3% hit rate. We have to remember that very few ideas that we come up with are actually going to end up moving the needle. What this 4% implies is that when we own a great business, we get into the wonderful situation of owning a great business, we should be very reluctant to sell the business. We should be reluctant to sell the business when it's fully priced. We should also be very reluctant to sell it when it's overpriced. And we should be possibly the only time we should think about selling those businesses is when they are egregiously overpriced. And so this is where we depart from Ben Graham. And it's a very important departure to make. The risk of owning a great business above what it's worth, in my opinion, is lower than being in a constant gin and rummy game of buying and selling all the time. If we look at Berkshire Hathaway, longest held public equity that they've owned is Coca-Cola. They bought Coke in 1988, and so now it's 38 years. And if you think about Warren is going to be 96 this year. So the first buy and hold forever stock in Berkshire Hathaway came when he was about 57 or 58 years old. It didn't come very early in life. Now he started doing buy and hold when he started buying the businesses like See's Candy and so on. But on the public equities, that discipline came fairly late in life. And so many of you in the room are well under 58. You don't need to wait till you're 58 to figure this out. We've got it figured out now. These are some examples of businesses that I used to own and that I wish I still owned, and I no longer own, because there was overdosing on Graham and underdosing on Munger, which we're trying to balance off here. So the main reason I'm giving this talk is to just educate myself. So history doesn't repeat itself, but it does rhyme. And what I found is that when I talk to Charlie, and he's mentioned this several times, and even Warren's mentioned this several times publicly, that the opportunity set that they had in the 60s and 70s, even in the early 80s, just doesn't exist today. And he said that what they were able to do, in fact, they've said repeatedly that if they were starting today, they would not be able to build Berkshire Hathaway. It's just that at that time they faced a much less competitive world with far fewer brain power applied to security analysis. But what I have found is that there are other parts of the world where similar situations still exist. And so, for example, what I found is that the Turkish stock market has a lot of parallels to what was going on in the US equity markets in the mid-70s and early 80s, et cetera, in terms of disparity between price and value. So we may not be able to find things exactly the way they were before, and things may not go back to the way they were, but you may be able to find it somewhere else. If you can't explain your investment thesis to a 10-year-old in about 4 sentences, it is a useless investment. Please don't make it. If you cannot, like in 4 or 5 sentences, explain it so a 10-year-old understands it, we're done. And a 10-year-old is not going to understand an Excel spreadsheet. The 4 sentences don't need too many numbers. They just need something very simple.